questions.
All right, let's get things kicked off. There's a lot of familiar faces that were just here at the last event, which I love. Thank you all for being here once again, because we do have an action-packed day. So this is we're the finale. So very thankful for this one about capital session unit economics to make sure that your numbers add up to a business. So just a quick overview. I think everyone has been to the EC before. Is there anyone that hasn't been here or still curious what exactly we do? I think everyone has heard my spiel more than 5 times at least. So I'm going to give you sweet, short. What we do is we want to make Nashville the best place to start and grow your business by providing the necessary resources through membership, but also through our accelerator programs. I still do want to highlight our accelerator programs. So this is going to be a curated experience based on either your startup stage or your startup stage or your business industry. So we have takeoff for those that are ready to launch their business, in flight, those are going to be the ones that are growing, scaling their business, 20 Day for Founders of Color, and then our 2 industry focused being Project Healthcare and Project FinTech. I do want to highlight another thing that's very important about these. So with the fall cohort, we actually have $40,000 worth of grants that are available. So if you get accepted in one of these programs, you go through it, you have a chance of winning, up to $40,000 in that grant money. You can find out more about how those grants work and how they're distributed on our website. And also you can learn more about the programs on our website as well. But let's get kicked off. So thank you to our community partners, CommStasis for secure, reliable IT, and also we have Metro Nashville. Thank you to our growth partners. So one of them being CLA. If you're from CLA, please raise your hand. Give them a round of applause, yes. Yes, thank you so much. So they are our accounting partner, and so we'll hear a lot more about CLA, what they do, and how they can help you as a founder. We also have a banking partner, Pinnacle, RJ Young for tech, Becker Donaldson for legal, and the Nashville Area Chamber of Commerce for community. We also have our supporting partners. So you see a lot of names up there. I won't read them all, but we cannot do what we do without all of our partners, whether it be community partner, growth partner, or supporting partner. Along with LaunchTN, so they are kind of the center web of all ECs in Tennessee. So kind of their main specializations are connections, capital, commercialization. So if you're looking to learn more about any of this or how they can connect you to those necessary resources, that QR code might help you out a lot. They also have InvestTN. So this is a separate section that they have for non-dilutive equity matching funds. If you're interested in this, of course, you're here, so you're interested in fundraising for your business. This might be a really good opportunity for you. You can once again scan that QR code, learn more about it, see if it fits what you're looking for. And without further ado, we're going to get kicked off straight to the panel. So I'm going to welcome Hannah and Craig up to the seats, and they're going to do a quick introduction of who they are, but then also their companies they work for. Give it up for our panelists. Let's kick off first.
Well, hi everyone, I'm Hannah. I work with a company called Forecaster. Forecaster is a startup ourselves, so we are actually raising our Series A, so we're pretty early stage, just like a lot of you guys. So I'm kind of in the day-to-day just like you all are, and scrappy founder stuff. I'm not a founder, but able to see how our founders are working through those problems that we're facing as a startup. So Forecaster is an online financial model. We have custom dashboards. We integrate QuickBooks, so you can compare QuickBooks and Xero, so you can compare your forecast versus actuals. We do reporting. You can share the model with your investors, so we can set up like custom permissions and all of those things. So a really great tool if you're looking to fundraise, but also just to like manage your business. I'm super excited to be here.
Thank you so much. Craig?
Awesome. Thank you. My name is Craig Ayers. I am from Minnesota, 35 years in the industry, and I'm at CLA. Now, we have us listed as the accounting partner up there, so we're proud to be a supporter. My role is I work with companies kind of through their startup to exit. I'm not a founder of a business, but my wife has recently launched a business, so she's pre-revenue. So a lot of the things you guys have maybe gone through, I am seeing my wife go through it, and AI is a wonderful thing. As I see her kind of leveraging it. But at CLA, when we're working with, I'll say, businesses, privately held businesses, there's a lot of things we work with them on, and that's kind of from startup to exit, and we'll do accounting, tax, some outsourcing, business planning, mergers, acquisitions, and we help companies raise capital as well. So thank you, and glad to be here.
Thank you so much. All right, so I want to get straight kicked into the panel. We do have a packed agenda today, so we're going to do the panel session for the first half. And then the second half will be the workshop, so more hands-on experience. So just a reminder for that, at the end we'll ask, make sure that everyone who's staying for the workshop has the correct ticket, but very thankful for you all to be here. But let's get straight into it. So I have a list of handy-dandy questions I'll ask you all. Then we'll have an opportunity for you all near the end for a couple of questions. Of course, we want to save a majority of those for the workshop side of things, but we will allow some of those. So to start off with, I have, so let's just start with the basics. Why is understanding your unit economics so essential for startup founders, even at the earliest stages?
Anna, you want to take that?
Sure, I'll start. Okay, there we go. So unit economics, what are they? So essentially, unit economics tells us how profitable one unit of our business is. So whether that's one new customer, one new sale, one employee, what are the economics of that one unit? And super important to understand those unit economics, because if we don't understand that, we don't know if we should actually be selling this product. If our product isn't making us money, if we're not getting more revenue than it's costing us to make that, we probably shouldn't be doing it, or we need to go find ways to reduce our costs. So super important to understand that. And when an investor is evaluating your business, that's one of the main things they're going to look at is how much money are they making off of one unit. Especially if you're looking to sell your business someday, your fixed costs, that acquirer is they're gonna absorb those. But they really care about that unit, that delta between your revenue and your cost of goods. So you want to really make sure that you have that dialed in and really understand that. And understanding your unit economics really helps you improve efficiency of your business. So we want to run as efficiently as possible. We don't want to waste our resources. So really understanding that can help with that efficiency.
Yeah. I always like to ask founders of businesses, a couple things. The first question is, do you watch Shark Tank? Oh, how's that? Is that better?
Yeah,
Can you hear me?
Yeah,
So I always like to ask, do you ever watch Shark Tank? Right? There's a few people that do. The first question they ask is, do you know your numbers? Right? And, everything that Hannah just said, extremely important, right? And I always go, there's three things to kind of walk away with is, hey, do you know your numbers? What problem is your product or service trying to solve? And then don't overvalue your company, right? And if you do those three things, then you're going to be in a position to grow your business and be able to raise capital because you've got, the numbers, you can articulate that, you're solving a problem, and you have a realistic ask when you're going to capital raise. But it all starts with you're solving a problem, and then you know your numbers.
Yeah, absolutely. And so that even happens at the earliest stages. So we got a little bit into some of those metrics that you all talked about as far as cost of goods, things like that. But what are the key metrics every founder should know? So CAC, LTV, and contribution margin. And what do those numbers exactly tell us about a business?
Sure, I'll talk about there are a lot of different metrics that you could analyze and understand. I'll hit on a few of them. So the first one I'll touch on is gross margin. In my opinion, that is one of the most important metrics that you should know. How much are you actually making off of one unit of your good or service? So you really need to understand that how much money is left over to cover all of my fixed expenses. On Shark Tank, they always ask, what are your margins? You gotta know that answer. And then, CAC, customer acquisition cost. CAC is the shorter version of that. So how much money does it take? How much money does it cost you to acquire one customer? So let's assume that I do Google ads, Google paid ads, and I have a budget every single month. I get X amount of clicks on that, and I get a percentage of those clicks turned into customers. So I look at the number of customers that I have, and I divide that by the amount of money I spent to actually get that customer, so how much I spent on my ads, and then also how much money I spent on my sales and marketing team. Add those two numbers together, divide by the actual number of new customers I got, and that's how much it cost me to get that customer. And so you want to make sure that cost to get your customer is less than what you're making on that customer over time, because you want that to be profitable. And maybe you're not profitable on that customer in month one, but it's a subscription business, so they stick around for a while. So we need to go look at, okay, how much money am I going to make on this customer over the lifetime? So the first step is to figure out, how long is this customer going to stick around? What is my assumption on that? Sorry, this could get long-winded. I feel like I'm helping you solve a math problem. You have to know your churn rate. So how often is a customer churning? And so is that 5% of my customers churn every month, 10% of my customers churn every month? It'll be different for every business. 1 divided by churn gets you your average months the customer stays with you. And then how much money, you have to just figure out how much money a customer is paying you on a monthly basis to figure out how much they're going to pay you over the lifetime of their business. And then you're going to compare the lifetime value of a customer to the cost it took you to actually get that customer. And so then you can see, okay, over the lifetime of this customer, how much am I actually making? So if my lifetime value of a customer is only $1, and I spent $1 to get that customer, I'm not making any money. I just got my money back. And there's nothing left over to cover my fixed expenses. So it's probably not a great investment unless I'm going to get more efficient over time. So it's definitely something you want to focus on. So I'll stop talking there. You can hit on some other.
No, that was really helpful.
No, that was very good. I would say there's probably a couple other things, and this probably starts to get into, the second half, but you start looking at, people ask about, depending on the stage of where you are, is, hey, what's your cash burn rate on a monthly basis, right? And that's going to get into modeling and kind of saying, hey, how much cash am I using on a monthly basis to run my business? What are my fixed costs versus variable costs, right? So now you're starting to be able to articulate, some of the risks of an investor is going to be looking at as far as, hey, cash needs, fixed versus variable costs. You get into net promoter scores, that's getting, some of the things on the lifetime value, but then the net promotion score. If you can start gathering those are going to help you when you're going out to articulate how much you need from an investor. I was on the plane ride down here and I was sitting next to somebody and they were raising capital and they were concerned about, hey, in that first round, are they raising enough, right? Because you don't want to have to keep going back to your investors. So understanding the economic unit, understanding your cash burn, the net promoter scores, and then I call it the sustainability of cash flow, that recurring cash flow that you have. You don't want to have a business that you go, oh, I added 100 customers, this month, and oh, by the way, I lost 95, right? So all of a sudden, that's not a very good metric to be going out to the market on.
Yeah. So how many of you all have solid data on some of these metrics? Raise your hand if you do. All right. Okay, so you have solid data. That's great. So if you don't have solid data on this, so for one, we'll be able to answer they will be able to answer a lot of these questions during the workshop as far as what the things to look for. But for that, so for startups that are pre-revenue or don't have solid data yet, how can they approach building a unit economics model that still holds weight?
You want me to start? first off, I kind of go, you start with the basics. You don't need a complex model. There's ways to get those complex models, but I always tell people just start writing it down on a piece of paper, the cost to, get the product, the service, and basically just keeping good data on, say, what is my cost to produce, the time that it's taking, and then what am I selling it for. You gotta have the basics of capturing that data so you can plug it into the model to capture and be able to start to build off and have that foundation to capture the kind of the key performance metrics.
Yeah, just to add to that, at Forecaster, we've worked with a lot of pre-revenue companies, and we always say start from the bottoms up. Like, what are your customer acquisition channels? What do you think is actually going to happen? Let's simulate your business. It's so important to just like build the bones to simulate what would happen. What if I did actually spend $100,000 on marketing every month? What would happen? What do I think would happen? So just building out the bones, the simple bone structure of a model is really important. And talk to your friends. How much did you spend on Google Ads, and how much did it cost you to get that customer? So like gather data, go do research on the industry, and kind of fill in those inputs. And then once you're kind of happy with your inputs, then take a step back and just be like, okay, calculate your metrics. So okay, this model I just built is telling me that my CAC is way higher than my lifetime value. I need to go back and actually reassess this. So using like the metrics as a checking point as you're building your model. I truthfully think that like everyone needs a financial model. I think it's super important to have a simulation of your business, even if you don't have a ton of data, just have a starting point. But then as you're starting your business, just be aware that you need to track some of these things, setting up those systems to start tracking these metrics and things like that. It'll go a long way if you're keeping track of these things, and you can actually articulate to an investor, well, this was actually my customer acquisition cost. Like, I actually have data behind these assumptions in this model.
Yeah, and so speaking of like the financial modeling and things like that, in your experience with what you've heard, so what are some financial red flags that investors often spot right away, whether it be in the pitch room or the data room?
Well, I'd probably go back to comment number one is, do you know your numbers, right? I mean, that to me is probably, when I say that is, do you know the cost of the product? Do you know the cost of the service, the revenue? It's really, those to me are the red flags, because a lot of times people will come in and they'll go, oh, I want to raise $1 million or $5 million. And then you start asking them the data and the numbers behind it, and they don't have a handle on what those numbers are. You don't need a sophisticated model to be able to say, hey, you know what, my sales were 500,000, 200,000 by month, here are my channels. Having that understanding, deep knowledge of kind of, hey, who am I selling to, what the cost is, that to me is kind of the baseline. And then you can start getting into some of the other things as an investor of, hey, what's the addressable market, right, the opportunity. But if you don't know the numbers, if you can't articulate the numbers and what you're going to use that capital for, or the cash that you're raising, that to me is what I see as the biggest red flags.
Yeah, I would fully agree with that. When I sit down with founders and we build their model, I ask them, okay, now you pitch this to me. And I'm going to see if like what you're telling me actually matches up with like the numbers that I see here. So I would say, yeah, make sure that the numbers match the narrative that you're trying to tell. And then maybe some more like technical things to watch out for is like a gross margin that decreases over time, or that gets worse over time. So you want to show efficiency. So make sure that the cost to sell your product isn't getting higher as time goes on, or the cost to produce your product isn't getting higher. An unrealistic burn. We want, like I said, we want to be good stewards with our money. So keep an eye on that burn.
Yeah, and so with that, so how would you say like the unit economics, so like more like a deep dive into it of how the unit economics impact decisions, strategics behind pricing, hiring, or marketing spend? So like a little bit more in depth on how those unit economics affect things like that.
Yeah, so let's say I'm selling a product. So I have a customer now that's selling a snack product, and she's going through the process of figuring out with her manufacturer how much it's going to cost. We don't actually know what the price is going to be yet because we have to figure out how much it actually costs. So we're actually going to reverse engineer this because she said she wants to make sure that she has a 75% margin, gross margin on this. So once we have the cost, then we're going to be like, okay, in order to achieve the 75% margin, we need to price our product at this dollar amount. So keeping an eye on and knowing what your target metric is, that will inform, that'll help you make the decision on like the price to charge or things like that. Another metric that I didn't quite talk about yet is like employees. So how efficient are your employees? So looking at like taking revenue divided by the number of employees that you have, how much money, how much annual revenue is one employee producing for my company? I think a lot of founders think that they can run their business with not a lot of people, and you usually need more people to actually do the work. And it could be getting different with like, with AI and everything coming on board, but like metrics like that, of like how productive are my people? So that could maybe inform your hiring decisions in the future, things like that.
Yeah, I think those are great points. It's kind of interesting. I think AI could be changing a lot of things as well, as far as creating assistance and, leveraging that to help you run your business and make it more efficient. The kind of revenue per person, I think that's a great metric to have. I look at that a lot. It doesn't tell you everything, but it does kind of go to how efficient is your business. So I think that's critical. The other thing is, I think you have to look and try to decide what are also the most critical things of your business. I talk to my wife a lot about, she's got this strategy and she's trying to launch this company, and there's things that she's got to be able to do strategically, and there's things that she can delegate and get other people to, and that's where she's going to get a return on building this business. And if you're in the business where you've got a product and you have inventory, I just have one ask: please count it, make sure you know how much you have and where it's going, because there's so many businesses we work with that all of a sudden you're going down a path and they're going, wait a minute, they shortcutted. They didn't want to hire to have somebody who is managing kind of, I'll say, inventory, and all of a sudden now your numbers are off because inventory's been inaccurate. So there's critical kind of, I'll say, tactical decisions of saying, hey, what's important to make sure I know what my numbers are so I can articulate that, but yet manage and have good control of my business as I launch it and grow it.
Yeah, so I want to dive into a little bit of like the capital efficiency. So how does the metric tie into a founder's story when they're trying to raise money? And this could be as simple as, it's very important, you got to make sure you have these metrics down, or the people that you're pitching to are just going to kind of look at you and just like, you're missing a lot of information here. But if there's any more information that you could tie into as far as when they're going to raise money and how important these metrics are, just a little insight on that, if there is any more.
Yeah, I mean, I'd say there's a couple things that I would point to, right, that are important, right? You got the capital efficiency kind of metrics that are out there, how efficient as you're putting money into the business, and the return you're getting on that. Additionally, I would say, when you take a look at metrics around, the CapEx and the needs you have, some people would look at that and say, hey, is that the best use of that cash? So you have to have a good story of why are you spending that money on certain assets? Is that really what an early stage company should be spending? I mean, sometimes if you look at CLA as we greenfield locations, right? We started a pretty small office. When we greenfielded downtown Chicago, it was me and 4 people sitting in about a 4x4 office. Why? Because we just said, hey, to be efficient in launching this, that's not where we want to spend the money. We want to spend the money on advertising or getting out in sponsorships and doing stuff like this. So that's where you can kind of point to say, hey, I'm spending less on this, it's overhead, and I'm spending more on employees, getting to customer acquisition costs, things like that. So I think that's the story you try to put together to say, hey, the cash that I have available as I'm bootstrapping this, I am using as efficient and effectively as possible.
All right, looks like you hit the nail on that one.
Every once in a while that happens, not very often.
So I just have like one kind of wrap up, and then we're gonna open it up to you all for some questions. So as far as like everything that we talked about today, so if a founder walks away, you all, from this panel with just one action item or mindset shift over kind of the topics and metrics and everything they should kind of think about when going through this, what should it be when coming to own their numbers? What should they walk away with from this?
I would say that everyone should go home and make sure you understand your gross margins. How much does it actually cost me to produce my product or my service or deliver my service? So I can just give this, like, if you're a SaaS company, you've got hosting costs, you've got, if you have help desk people that are servicing that, and maybe you have like some integrations, like you're using Intercom, for instance, to like answer questions on your website. Those are the like three main things, just to give you a head start on like what it's going to cost you. If you're a product company, obviously you have your product costs. So go home, look at how much it actually costs you to produce that. So you have that, you can answer that question of how much. What are your gross margins? So when Shark Tank calls, you have the answer.
Yeah, and maybe the only thing I would add to that, right, I go back to, know your numbers, that is critical, and to know the numbers and you know what your margins are now, whether it's a service, product, combination, it's know the numbers, know your business model, as well as just because your margin might be 20%, 70%, whatever it is today, what are the ways that you can continue to improve that margin? To me, that's also kind of important, but it all starts with, do you really know what your numbers are?
And understanding what the average is for your industry, because all industries are different. So I think you should definitely look into that.
All right, I want to open up to questions. I feel like, so for one, keep in mind, there will be the workshop portion. If you're staying for that, there will be a lot more hands-on activities, opportunities there. But are there any questions from you all as far as, hey, it's about your business? Maybe there's a specific, yes, Dylan.
Yeah, as like a pre-revenue company, like what assumptions would you guys say like are most often miscalculated? Period.
I would say number of new customers a lot of the time. I think people assume a super high ramp up right away, and it's going to cost you a lot more money than you think to acquire your first few customers unless you have like a really great acquisition strategy. So I would just be realistic with yourself about how many customers you can actually acquire. I say that's a big one, and then churn. I think we get wrong a lot of the time, especially as our product maybe isn't as good as it could be at the beginning.
Yeah, Dylan, I would agree. I would say run a bunch of different scenarios. Like, hey, this is kind of optimistic. This is worst case, and this is maybe my best case, right? And probably, you probably end up, I don't want to say on the worst case, but you're probably not going to hit that high. You're probably more, kind of in that middle to lower. But that's where a lot of times I will see overly optimistic, right, models. And then you go out to an investor and they're like, no, right? And then it's kind of like you've just lost it. You're better off going in with, you get to, I think I started with know your numbers, and the last one, don't overvalue your company. Well, if you go out pre-revenue with this, hey, I'm going to be $1 billion company in 3 years. Well, CLA is a $2 billion company after, Marcus, how many years?
Oh boy.
Yeah, a lot. Almost 100.
I was going to say 1938 maybe you said?
Yeah, right? So it's not easy to get to $1 billion, right? So be realistic in those models. It's better if an investor said, hey, I'm going to put money in at Dylan. I think we can do better than that, and let's do it together.
All right, we'll go Nishay first, ladies first, and then we'll go Darius right behind you. So go ahead.
Yeah, so starting out, like you said, can be very basic with like spreadsheets and things like that. Even that gives me anxiety. Do you recommend like any software that helps you track a lot of these metrics? Like, I don't know, do you start with QuickBooks? Like, is there a way I can just kind of plug and let things calculate? I don't know. Numbers are not my friend.
I mean, Forecaster is there.
Did you pay her?
Great
Yeah,
question.
Forecaster is a great tool to help track all this data because we integrate with QuickBooks. So you can say, okay, I forecasted this to happen this month, but based on that, what actually happened, I'm looking at QuickBooks. I did or I did not hit that. And then we can dig into the why behind it. And then we can, in Forecaster, we can calculate all those metrics. But if you are not at that point to like invest in a software like Forecaster, our lowest plan is about $500 a month because you get a human alongside of that. But if you're not at that point, we also have templates on our website that you can use. So definitely think about using that. Yeah, do you know of any other tools? I know like sometimes accounting firms will have stuff.
Yeah, there's a lot of different tools. My wife printed off, I don't know if anybody's heard of Dave Ramsey and his financial planning kind of. My wife printed off a few spreadsheets from Dave Ramsey and just wrote down what you thought. I mean, that was her starting point, right? Just say, piece of paper, I'm gonna write it down. Dave Ramsey had a little format, she used that. But there's a lot of different kind of tools you could Google and find. You guys have something, CLA sits down with a lot of business owners and puts a model together, but I think you probably even just print something out and you start there. That becomes the key, and then you have a basis to go forward.
Yeah, and I can try to share Forecaster's free resources after this as well with everybody.
That'd be perfect. Darius, did you have that question?
Yep.
Oh, that's the same question. Okay, gotcha.
I'm gonna piggyback off it.
Okay.
So with the $500 a month you're talking about, if you have multiple businesses or if you run a program like several businesses like come into one group, like a cohort, you guys be able to provide work with developing some type of template that could start, that these companies could start off with to be able to determine what their burn rate is, all of their rates associated with the development of their company.
Yeah, every one of our customers, like we build a custom model for. So you're saying that you work with you specifically have multiple businesses?
I do, but I work with multiple companies, so like that are startups.
Okay. Yeah, I would say each company would come in and get their own model built. Like we work with them specifically to figure out. Yeah.
But basically, the $500 that you're talking about a month, you build out a program for everybody with that $500.
Yes. Yeah. It would be $500 per customer per business. Yeah.
John, did you have a question?
I think that his question answered part of my question. It was about the CFO services that you have. So that's what he was.
So we have 3 different tiers of services. We have like our base level, which is our essentials. So you get 30 minutes of meeting time every month, and a financial analyst assigned to your company. You can email them as much as you need. That's $500 a month. There's discounts if you sign up for like 6 months or whatever, so it can become lower. And I think if you go to an event that someone speaks at, we also give a discount, so I'll get some details on that. So we have that plan, then we have like a monthly plan, or our growth plan, which is more meeting time with your analyst. And then we have CFO services on our, we offer CFO services, and I sit on that team. And that pricing is custom, because everyone needs a different level of support.
So yeah, I mean, I basically have the go-to-market strategy broken down into revenue for what it's going to cost me to do what they're asking me to do, or what I'm asking them to do. Excuse me. But it doesn't have a return on what the customer possibly could bring. So, in figuring out how to monetize an online business, that you factor in those inputs and help develop that model with your strategy?
Yeah, we would help you think through like your call it revenue formula. We'd help you like think through like how you would actually monetize those customers. We're not gonna like tell you, I guess, what your revenue structure should
No, but
be.
you could make suggestions. That's,
Yeah, for sure. I mean,
based
our
on-
analysts have helped hundreds of companies, so we've seen a lot. So we can definitely help like steer you in the right direction and guide you on that for sure.
I know there's gotta be some more questions. All questions are welcome. Dylan, let's do it again.
I maybe jumped too far ahead, so try and stop me if this is for another class down the road. But say like we get our numbers right, we know our story and all that stuff. Like out of the numbers that like we're creating with gross margin, our return cost, return rates, all that stuff. There's a ton there. Like when you go into the like, I need to raise some money. How do those numbers, like the baseline of your business, help inform you to know how much do I need to raise per se? And that could be it's probably a bigger conversation. There's probably a lot that goes into it, but like, what are some of the first thoughts that you think of like as like a business? Does that make sense?
Yeah.
Yeah.
Okay.
I can't answer it, but it makes sense to me.
You
You can go first.
Okay.
I'll add.
So, there's probably a couple thoughts or concepts there, Dylan, that you'd want to think about, right? Is if you know your kind of current numbers, right, you then have to, I would say, this gets to the third point when I go, don't overvalue your company and don't undervalue your company, right? So you know what your numbers are, right? Now you're gonna go raise capital, and you got a couple questions, right? Is what are you gonna raise it for? What are you trying to do? Are you trying to continue to grow, or are you trying to take an exit? And then kind of what are your goals and objectives gonna be with that, right? So a lot of times, at least early on, people are trying to raise capital to continue to grow, to create the value so that they can have an exit later on, right? I kind of look at it and I say, hey, for some of you, this might be your 401k, this might be your retirement asset, I don't know. But if that's the case, then the amount of money you're gonna raise and how you raise it is gonna be different than if you're as old as I am and it's a retirement play, right? So then it becomes going, hey, do I need 1 million? Do I need 2 million? And then that's going to be kind of driven off of what am I going to do with that money? So, and then from there you could go and say, well, then how do you value to say, am I getting the right kind of valuation on my company to raise that? And I would say, you got people like John and Marcus here that say, hey, what we do is try to help you on the valuation so that you are going out to have the right ask to that investor. You're going to tell them, hey, here's my numbers, here's my story, here's what I want, here's what I'm going to do with it. This is going to create X amount of value. You're going to win, I'm going to win.
Right. And from a pre-revenue side of things, the valuation aspect of that is probably very challenging. It's like, hey, I make no money, but I think I will.
Trust me, I'm going to be $1 billion in a year.
Yeah. My market's 16 billion. It's gonna be great.
But that's probably the art of that, right? Is because then you're going to sit down. Trust me, say last year we worked on a deal that was a company in Minnesota that had that medical device, and they were basically saying, well, we're worth $1 billion, right? Well, and then we modeled it out and kind of said, well, we can't get to $1 billion, but we got up to 600 million, right? And then Medtronic made the investment. But there's metrics you can do to, kind of say, hey, how do I come up and say, what is that addressable market? How can I get there to kind of try to maximize the value? But yes, it's more challenging, and you're going to find investors are going to be, a lot more skeptical. On trying to help on that valuation of pre-revenue companies.
Yeah, the pre-revenue it's hard, but you're probably gonna raise on mistake, I assume, if you're raising money if you don't have revenue. So I would just think about, okay, my next round, or how much equity would I be comfortable with selling in this round? And that will inform your valuation cap on your safe. So then you can kind of back into, okay, how much, or if I'm gonna raise $1 million, my valuation, and I only wanna sell 20 million or 20%, okay, my valuation cap is 5 million. Okay, I think I can go with that to an investor. So it's kind of like math like that, I think, at the really early stages. So yeah, that's how I would handle that one. And then I would also say, like, on the amount to raise, like, I think your model informs how much you need. So, like, as long as you put the numbers in the model and you looked at, like, your lifetime value, or you looked at your customer acquisition costs and it makes sense, it's like, okay, this is within, like, industry standard. So I know that I'm not spending way too much on marketing. I'm not asking for too much in this area. I can justify this when I'm talking to an investor. Like, as long as, like, all of like the inputs make sense and your story fits around that, the model's gonna tell you you need $1 million to get 18 months. You know, so then you know how much you need because the model's telling you. And I would say always add a buffer in too.
And I would say to this group, sometimes, you know, my wife decided that she's hopped on different calls with venture capital firms that are raising funds right now, because she wants to know, what are you looking for? You're raising this money, you're gonna make this investment, what are you looking for in those companies? So she's hearing from them what they're looking for, so that she can figure out, okay, I'm gonna build this into whatever pitch deck I put together for them. So, you know, that's where I'd look and say, okay, who are the investors, given your business, your niche, who are the investors that might be interested in a business like yours, right? Now, in startups, a lot of times I'd say they like to be local, right? A venture capital or an angel fund in Tennessee is probably gonna wanna invest in a startup in Tennessee, not in Minnesota. So starting to know that ecosystem can kind of also help you get prepared for going out and raising the capital.
I think I have a question. So if, back to the pre-revenue side of things, when you're trying to gather these metrics and look at numbers and you don't really have them, is it ever a good idea to kind of put numbers together based on competitors, their numbers? Is that ever a good idea? That's something they should look at, or it should be completely separate?
I think yes. I think you should definitely benchmark yourself against other companies. That's what the VC is going to do to you. It's because they know your pre-revenue. But so they're going to look at, okay, well, this is what the other companies in my portfolio are doing. I only invest in companies that are super efficient in this area. So I would definitely use these metrics to benchmark yourself, for sure.
Yeah, I would agree. I think it's also kind of, as you're benchmarking, now you can ask yourself why that competitor might be better than you. Why are you maybe better than that competitor, and start to understand maybe what your value proposition is, or it might tell you your numbers are wrong as well. At least it gives you some type of benchmark that you could look at and help you prepare, and maybe even help you in your business model. You can learn from your peers and from competitors.
Yes, Heather.
So this is gonna be sort of random, but what are your thoughts on factoring invoices? Or factoring your accounts receivable?
Well, I mean, how would I say this? It depends, right? There's a cost. And sometimes in factoring, there's a high cost. So I would always say, as you're looking at factoring and cash flow, make sure, this probably gets into some of the modeling, is kind of making sure you understand all of the options that are out there. I'm probably generally not a big fan of factoring of receivables, because I think in today's world, there's a lot of different ways to leverage those assets in a more cost-effective manner. What's that?
What are those?
Well, so sometimes, again, depending on who the customers are, right, you might be able to get a nice line of credit, or you can go to different non-bank financial institutions that can offer you, different kind of financing options that can be collateralized to the receivable that might be cheaper than factoring.
More questions? I won't pull teeth. There's no more questions. Then what we'll do is we'll take a quick 15-minute break in between the workshop. This gives you opportunity if you want to. For one, you've been here for a little bit, move your car so you don't get charged free parking with validation. And then yeah, just also be able to network with one another. So if you're staying for the workshop, if you have one of those tickets, we'll kick that off in about 15, maybe 10 minutes max. So help yourself, go to the bathroom if you need to, and see you all in a bit. And those first day for the workshop, we'll have snacks in the back as well.
Yes.
I am too.
Oh, where?
I grew up in Gainesville.
Oh, that's
Yeah.
good. So I'm a lot older than you.